Gold is approaching a major liquidity zone, and smart money is quietly preparing the next move. Right now, my daily bias is bearish. I'm looking for a premium retracement to sell short, targeting the 4314 sell-side liquidity pool. Most retail traders are completely focused on the wrong level today, distracted by the noise rather than tracking the institutional order flow.
So let me show you where institutions are actually hunting. My primary focus today is a precise sell setup sitting just above key liquidity. But there is one specific condition that absolutely must happen before a single dollar of capital is deployed. Let's break down today's institutional blue point. As I mentioned, the daily bias remains firmly bearish. The primary setup we're waiting for is a premium retracement right into the 4350 to 4360 fair value gap, and our ultimate drawn liquidity, that's the 4314.40 sell-side pool.
That specific 43-4140 level is the immediate magnetic draw for market makers today. The market is sending a warning signal to anyone trying to aggressively buy right now. Why? Because there's a dense cluster of retail sell stops resting just below the recent Asian and London session lows. This specific liquidity pool dictates exactly how we'll approach the New York session.
If we drop down to the 4-hour structure, you'll see that after price deliberately swept major external buy-side liquidity above the 44.47 swing high, institutional order flow decisively shifted bearish. They engineered that massive run to the upside specifically to distribute positions to retail breakout traders. Once those retail orders were filled, the market aggressively shifted downward.
Right now, smart money is actively drawing price down into this massive discount fair value gap, which sits between 42.60 and 42.85. They aren't just moving price for the sake of it, they're rebalancing the explosive, inefficient rally we saw earlier this month. The algorithms are literally programmed to seek out that deep discount zone. That's our macro objective.
Zooming into the 1-hour chart, price is delivering a very methodical bearish expansion. Notice how it purposely leaves relative equal highs completely intact around 43.66. They are actively engineering that buy-side liquidity. They leave it untouched to build false confidence for early retail shorts, all while systematically pressing price toward the internal lows. This brings us to the actual N15 execution model. Step 1. Do not chase price down into support. Wait patiently for a premium retracement up into the 4350 to 4360 level. Step 2. Confirm a 15-minute market structure shift. And Step 3. Execute the short. It's that simple. If smart money confirmation hasn't appeared, there is no trade. Your primary sell zone sits perfectly inside this open 15-minute bearish fair value gap. Now, as price trades up into this premium array, we require a clean rejection, a break of a short-term low, and a clear displacement footprint. If price just violently slices through this zone and holds above it, the setup is entirely void. If the setup triggers according to plan, your risk profile is mathematically asymmetric. Your stop loss goes safely above the 43.72 swing high. Your first major take profit targets that 43.14 liquidity pool we talked about, giving you a high probability risk to reward scenario of roughly 1 to 3.5. Total invalidation for this idea occurs if price closes firmly above 43.92. But here's the problem. This exact setup is where smart money creates a devastating trap for retail traders who are looking strictly at fundamental news calendars rather than the underlying liquidity matrix. This is the scenario most traders are ignoring, and the herd is completely blind to it. Think about it. Retail traders see weak US PPI data, assume the Fed will pause rate hikes, and reflexively smash the buy button on gold within seconds. They're trading a headline, completely ignoring the liquidity cycle. They expect an instant macro rally, blissfully unaware that institutions are actively engineering a sweep of their stop losses first. However, smart money may be targeting something completely different. Tonight, high-impact US core retail sales and consumer sentiment data drop during the New York session. The algorithms don't actually care about the economic numbers themselves. They use these releases as the perfect injection of volatility needed to complete their delivery cycles.
Institutions will likely use the algorithmic run-up into these news releases to aggressively sweep those 43.14 sell stops, clearing out all retail longs before delivering any real upside expansion. Don't try to forecast the news direction. Instead, expect the volatility to be weaponized to clear stops, tap into that deep 4-hour fair value gap, and fill institutional orders at a massive discount.
Let's do a quick recap. Remain bearish towards the 43.14 level. Wait for that 15-minute structural confirmation inside the 43.50 fair value gap. Be highly vigilant of a false breakout liquidity sweep during the New York news events, and as always, risk a maximum of 1%.
If you found this explainer on institutional market analysis and smart money concepts valuable, make sure to subscribe to ICT Market Theory. And if you'd like to trade alongside these exact setups with professional execution, you can find the FXTM account link in the pinned comment below. As we head into tonight's volatility, you have to ask yourself one question. Will you be the one providing the liquidity, or will you survive the New York sweep?